Okay, so you want to own a SaaS company. Build an app, charge a monthly fee, and watch the recurring revenue stack up while you sleep. No inventory, no trucks, no factory. Just code, a subscription button, and a bank account that fills itself every month. It sounds like the cleanest business model ever invented. And in a lot of ways, it is. The global SaaS market is projected to hit approximately $465 billion in 2026, growing at nearly 19% a year. That is not a niche. That is one of the largest, fastest growing categories of business on Earth. And yet, the majority of SaaS startups that get funded never become profitable. And a shocking number of the ones that look the healthiest on paper are quietly one bad quarter away from collapse. Because the number nobody puts on the pitch deck is this. In 2021, at the peak of the market, the median public SaaS company was valued at nearly 17 times its revenue. By early 2023, that same median company was worth roughly 6.7 times revenue. Same product, same customers, same code. Just a 60% smaller number attached to the exact same business. That is the gap this video is going to walk you through. By the end of this video, you will know exactly why a customer who signs up today can already be a loss on your books before they ever pay their second invoice. How a single spreadsheet formula, tracked by almost nobody outside of finance teams, quietly decides whether a SaaS company can fund its own growth or has to keep begging investors for more cash. And why the company that built the most trusted, most profitable subscription business of the last decade did it by refusing the entire playbook everyone else was using. Before you write a single line of code, you need to understand what a SaaS company actually is at its core. It is not, at its heart, a software business. That sounds strange for a company whose entire product is software, so stay with it. What a SaaS company actually sells is not the code itself. Code is infinitely copyable and, on its own, worth nothing. What it sells is a habit, the guarantee that a customer's data, workflow, and daily routine will keep working exactly the way they've built their life around it, month after month, without them ever having to think about it again. The moment a customer has to think about your product, you have already started losing them. Every feature you ship, every server you provision, every support ticket you close either deepens that habit or quietly gives the customer a reason to cancel. This is why the entire financial structure of a SaaS company is built around one single question. How long does a customer stay, and how much does it cost you to keep them staying? Let's talk about what it costs just to exist. The smallest viable SaaS company, a founder, a laptop, and a product listening on a single cloud server, can technically launch for a few $1,000s. That sounds appealing, and at that scale it is. But at that scale, you don't have a company. You have a hobby with a Stripe account attached. The moment you want a single enterprise customer to actually trust you with their business, the bill changes completely. A first SOC 2 security audit, the compliance certification nearly every mid-market and enterprise buyer will require before they sign a contract, costs a small SaaS company somewhere between $20,000 and $80,000 in the first year alone. Once you count the auditor's fee, the readiness assessment, the compliance software subscription, and the engineering hours spent closing security gaps. And that is not a one-time cost. Annual renewal audits run another $15,000 to $40,000 every single year after that, indefinitely for as long as you want enterprise customers to keep trusting you. Then comes the part that never makes it into the pitch deck: cloud infrastructure. Hosting a small SaaS product reliably, with backups, monitoring, and redundancy across regions easily runs several $1,000s a month even before you have meaningful traffic. And that number does not grow slowly. It grows in direct proportion to your success, which is exactly the problem we'll come back to. On top of the audit and the hosting, add basic legal setup, a terms of service and privacy policy that will actually hold up, payment processing integration, and the first few engineering hires. Before you have signed a single paying customer, a genuinely credible SaaS startup has spent somewhere between $150,000 and $400,000 just to exist in a form serious buyers will trust. That is the cost to be taken seriously in this business. Now let's talk about the cost to actually operate. The single largest recurring expense in any SaaS company is not the server bill. It is not marketing. It is people, specifically engineers. And the number that almost never appears clearly in a founder's early financial model is customer acquisition cost. Depending on which benchmark you trust and which segment you're selling into, The median B2B SaaS company takes somewhere between 15 and 18 months just to earn back what it spent acquiring a single customer, and that number was closer to 20 to 30 months during the toughest years of the post-2022 downturn. Top quartile, highly efficient companies do it in 6 months or less. The bottom quartile takes 24 months or more, and the worst performing companies in industry surveys take as long as 48 months. 4 years, just to break even on one customer, before that customer has generated a single dollar of profit. That single number is the hinge the entire business swings on, and we'll come back to exactly why in a moment. Here's the mechanism that catches almost every first-time SaaS founder completely off guard, and it does not have a dramatic name like a fuel surcharge or a demand charge. It's simply called churn, and it is the quiet leak at the bottom of every subscription business. Imagine you hire someone and pay them a $1,000 signing bonus, and they quit before their first paycheck even clears. You didn't just fail to profit from that hire. You are strictly worse off than if you'd never hired them at all. That is exactly what happens every time a customer cancels before you've recovered your SEAC. As of 2026, the average monthly churn rate across B2B SaaS sits around 3.3%, which sounds small until you compound it. That translates to something close to a third of your customer base, evaporating over a year if left unmanaged, though healthy companies keep annual churn under 5%. If your CAC payback period is 16 months and your average customer churns in 10, you are not running a subscription business. You are running a machine that spends real cash to acquire customers who guarantee you lose money on the way out the door. The revenue model, on paper, is beautifully simple. Take your monthly subscription price, multiply it by your number of paying customers, and you have your monthly recurring revenue. A SaaS company charging $100 a month with 2,000 customers is sitting on $200,000 in monthly recurring revenue, $2.4 million a year, growing every single month as new customers sign up. On a spreadsheet, that line only ever goes up and to the right. But that clean formula assumes every customer you land stays landed, and that assumption is where SaaS economics quietly collapse. The real number that matters is not new revenue. It's net revenue retention. What percentage of your existing customer revenue you still have 12 months later, after accounting for cancellations and downgrades, but also expansions and upsells. Two SaaS companies can have the exact same product, the exact same engineering team, and the exact same fixed costs, and still have wildly different economics purely based on this one number. A company with 130% net revenue retention barely needs new customers at all. Its existing base is expanding faster than it churns, and growth compounds almost for free. A company with 85% net revenue retention has to replace its entire shrinking base every year just to stand still, and every dollar of new customer acquisition spend is running uphill against a treadmill that's actively pulling backward. Same code, same team, same monthly price. One company is compounding. The other is quietly bleeding out. Let's look at what this actually did to real companies. In 2022, as central banks raised interest rates to fight inflation, the median public SaaS company's valuation multiple fell from a 2021 peak of nearly 17 times revenue down to roughly 6.7 times by early 2023, a collapse of more than 60% in under 18 months. This had nothing to do with these companies suddenly performing worse operationally. Datadog, for example, actually increased its growth rate during this exact window, and its valuation multiple still fell by roughly a third. The lesson is not that these were bad businesses. It's that SaaS valuations are duration assets. The more of a company's value sits in cash flows expected years from now, the harder rising interest rates hit that value today, regardless of how the underlying company is actually performing. Structural shocks in this industry don't always originate from inside the building. Then there is the cautionary tale of chasing growth before proving the unit economics. In 2022, the checkout startup Fast shut down after raising over $120 million, including a $102 million round led by Stripe. The company had grown to roughly 450 employees and was burning close to $10 million a month, while its entire 2021 revenue came in at approximately $600,000. It hired aggressively, spent heavily on marketing stunts, and assumed the next funding round would always be there to cover the gap between spending and revenue. When investor sentiment shifted in early 2022, The company went from a roughly $500 million valuation to a full shutdown in about a week. The product wasn't necessarily bad. The company simply built its entire financial existence around unit economics it had never actually proven. Let's put honest numbers on what this business looks like. Scenario 1, everything goes right. A SaaS company with Zua's customers paying $100 a month, $2.4 million in annual recurring revenue, a CAC payback period of 9 months, monthly churn held at 2%, and net revenue retention at 115% through consistent upselling. Annual revenue, approximately $2.4 million. Annual operating costs, engineering, payroll, cloud hosting, customer success, sales and marketing, and compliance, approximately $1.7 million. Net operating profit, approximately $700,000, and because retention is strong, next year's baseline revenue is already higher before a single new customer signs up. This is a genuinely healthy compounding SaaS business. Scenario 2, the realistic version. Same product, same team, same starting customer base. This time, churn creeps up to 4% a month as a competitor launches a cheaper alternative. Net revenue retention falls to 88%. Marketing spend increases 40% to compensate for the leak, pushing CK payback out to 22 months. Cloud costs, which scale with usage rather than staying fixed, rise 25% as the company scales infrastructure to handle a product launch, exactly the kind of surprise spike that hits a company's cloud bill the way one bad afternoon hits a demand charge. Annual revenue, approximately $1.9 million, as the shrinking base outpaces new signups. Annual operating costs, with the elevated marketing and infrastructure spend, approximately $2.1 million. Net operating loss, approximately $200,000. The difference between the good year and the bad year is $900,000 on the exact same product, the exact same team, and the exact same monthly price. Nothing about the software changed. Only the retention did. In 2001, Ben Chestnut and Dan Curtsius launched an email marketing tool called MailChimp as a side project funded by their web design agency's own revenue. They never took a dollar of venture capital, not because they couldn't have, but because they deliberately chose not to. Every dollar the company spent had to be earned first. That single discipline forced a different kind of company than the one built on the assumption that the next funding round will always arrive. MailChimp grew slowly, then steadily, then enormously, becoming profitable years before most VC-backed competitors had even found a path to it. In 2021, Intuit acquired MailChimp for approximately $12 billion, a company that had never raised outside funding, built entirely on the discipline of making its own unit economics work before scaling them. That is the opposite of the fast story. One company assumed the money would always be there to cover the gap. The other one made sure there was never a gap to cover in the first place. Step back for a second. The code is just the code. It costs almost nothing to copy, almost nothing to run at the margin, and almost nothing to demo in a sales call. None of that is the business. The business is the discipline behind the number nobody puts on the homepage. How long a customer actually stays, and whether that customer was worth acquiring in the first place. Right now, somewhere, there is a SaaS dashboard quietly recalculating a retention curve that nobody in the company has looked at all quarter, sitting one slipping decimal point away from turning a profitable year into a loss.